Hello, and welcome to the Credit Compass, your guide to navigating European credit markets. After an exceptionally busy January, this week feels like something of a pause, an opportunity for markets and policymakers alike to take stock of what we've just lived through. The political tone has clearly calmed, at least in Europe. That is, unless you happen to be in Canada. As a Canadian, I was particularly struck and genuinely proud of the speech delivered by Mark Carney in Davos. It was intelligent, measured, and perhaps unexpectedly emotional. Carney spoke directly to a changing global political and economic order, something everyone feels but not everyone articulates clearly. Europe, in particular, is feeling this shift, and arguably, it needed to. A sense of urgency is beginning to take hold across the continent, slowly, unevenly, but perceptibly. This week, we'll unpack the key takeaways from the many conversations in Davos, consider what they imply for Europe as we look ahead to 2026, and highlight several recent market developments that help frame where European growth and credit may be heading. All right, let's dig in. Davos 2026. Once again, the global elite gathered in Switzerland for the World Economic Forum. Unsurprisingly, the headlines focused on geopolitics, Greenland, trade tensions, and the renewed threat of U.S. tariffs. While these themes dominated the media narrative, they distracted somewhat from the conference's traditional core: business, capital investment, and long-term structural change. So, what actually happened beneath the surface, beyond the topic of Greenland tariffs and the familiar Europe bashing that has become something of a Davos tradition? Well, one of the most prominent themes was artificial intelligence and the capital expenditure supercycle now poised to move from planning into execution. Larry Fink, CEO of BlackRock and co-chair of the conference, argued forcefully that markets are not in an AI bubble and that there is still significant room to run. His view, shared by many asset managers and corporates, is that the infrastructure build-out required to support AI will underpin a durable investment cycle rather than a speculative one. But that optimism came with a clear caveat: electricity. The single biggest bottleneck threatening the AI boom is power. Existing electricity grids, particularly in developed markets, are simply not designed to shoulder the scale and intensity of demand that widespread AI adoption will require. As a result, we are likely to see a surge in on-site generation, accelerated grid investment, and a renewed push for efficiency upgrades. From a credit perspective, this matters enormously. Power generation, grid expansion, and energy storage, all capital intensive and long dated, precisely the kind of assets that draw in infrastructure debt, project finance, and structured credit. Governments and private investors alike will be searching for ways to fund this transition, as we have highlighted before. Is project finance suddenly the new sexy asset class? Perhaps that's a bit too far, but it is very clearly moving into the spotlight. Another recurring warning at Davos concerned the labor market impact of AI. Several speakers highlighted that while productivity gains may be substantial, the distributional effects could be uneven. Certain sectors and job categories are likely to be hit harder than others, with potential implications for social cohesion and political alignment. McKinsey, in particular, emphasized human capital as a potential bottleneck to AI-driven productivity gains. Their message to boards was clear: reskilling at scale is not optional. It needs to be budgeted for, planned for, and executed deliberately, or the promised gains from AI may fail to materialize. Private credit also remained firmly in the spotlight, despite recent headlines, particularly in the U.S. Appetite for the asset class remains robust. That said, increased regulatory and investor scrutiny is likely to tighten underwriting standards. This is not necessarily a bad thing. With competition among lenders still intense, improved discipline may help mitigate the risk of credit quality deterioration over time. Finally, and perhaps inevitably, tariffs dominated many conversations. The sense of a rupture in the historical global trading order continues to loom large. Companies are increasingly focused on de-risking supply chains and stress testing tariff scenarios at the sector level. This theme, more than almost any other, underscores how geopolitics and credit risk are becoming ever more tightly intertwined. Lastly, I made use of AI to get the European perspective on the Davos conference across local language news outlets. Here, Greenland eclipsed everything, with a great deal of focus on the comments out of the event on the test of sovereignty. Coverage moved from alarm over the tariff threats to relief at the rollback. Many focused on local job markets, stressing the risks from a return of tariffs to regional exporters. They will likely get some relief from my next topic, trade. Again, this time the focus is India. European Commission President Ursula von der Leyen had hoped to announce the long-anticipated EU-India trade deal at Davos. While that didn't quite happen, a process that has been nearly 20 years in the making appears to be finally reaching the finish line. This follows closely on the heels of the Mercosur trade deal, which has now been sent for legal review. That resistance suggests that not everyone has fully internalized Europe's strategic push to diversify trade relationships and reduce over-reliance on any single region. Let's hope the India agreement avoids a similar fate. According to the European Commission, the deal is expected to increase EU goods exports to India by more than 100% by 2032. Around 90% of existing tariffs would either be eliminated or sharply reduced. Importantly, this agreement also helps address some of the concerns raised by European farmers in the context of Mercosur. Under the India deal, tariffs would be eliminated on a range of agricultural exports, including fruits, olive oil, and processed foods such as breads and confectionery. Beyond agriculture, the industrial implications are significant. Automotive tariffs, for example, would fall from an eye-watering 110% to 10%, albeit with quotas. Machinery and equipment, the largest category of trade between the EU and India, would see tariffs drop from 44% to zero. India is currently the EU's ninth largest trading partner, with exports totaling roughly 75 billion euros. That figure is expected to more than double over the next 6 years. For Europe, this represents a meaningful long-term growth lever. Tying it back to Davos, investors such as Stephen Schwartzman from Blackstone and David Rubenstein from Carlyle highlighted that they felt India has already emerged and is not just an emerging economy anymore. They suggest that India could become the world's largest economy in 20 to 30 years. This trade deal will help both India and the EU to benefit from that expected growth. Now, let's turn to a few recent data points that highlight Europe's evolving growth picture. First up, Spain. Spain has been one of the strongest performers in the euro area over the past 2 years, and recent data suggests that momentum is continuing. Purchasing Manager indices point to ongoing expansion, and industrial production remains solid. 3 recent statistics are particularly noteworthy. Home sales rose 7.8% year-on-year in November, while total mortgage spending surged 24.4%. This strength is closely tied to improvements in the labor market. Spain's unemployment rate fell below 10% in the fourth quarter, coming in at 9.9% versus expectations of 10.25%. While 10% unemployment may still sound high, it's worth remembering that Spain's jobless rate peaked above 25% in 2013. With the exception of a brief COVID-related uptick, unemployment has been on a steady downward trajectory ever since. Fourth quarter GDP figures will be released soon, and expectations are relatively constructive. Next, a broader European indicator, new car registrations. EU new car registrations rose 5.8% in December and have now posted 6 consecutive months of growth. While there have been a few negative year-on-year readings along the way, the overall trend has been upward over the past several years, suggesting improved consumer confidence and replacement demand. Finally, the UK. Recent retail data initially painted a bleak picture, but subsequent details have been more encouraging. The CBI's retail sales balance improved sharply in January, rising from -44 to -17, far better than the expected -35. Official data from the Office for National Statistics also surprised to the upside. Retail sales volumes, excluding auto fuels, rose 3.1% in December, well above expectations of 1.7%, and the prior month was also revised higher as well. So, let's bring all this together. Political rhetoric was loud last week, particularly as headlines around Greenland and geopolitics resurfaced. Europe once again took criticism in Davos, with commentators pointing to slow decision-making and uneven progress on structural reforms. Yet beneath the noise, there are reasons for cautious optimism. The AI-driven investment cycle is real and ongoing. Europe's earlier push to diversify energy sources away from Russia, while painful, now looks increasingly like a strategic advantage in the world of AI. Further grid integration and infrastructure investment could lower energy costs over time while supporting AI-driven growth. Economic indicators across Europe are quietly improving, often surprising to the upside. New trade agreements, particularly with India and South America, should help reinforce this momentum over the longer term. So, what does this mean for markets? Well, markets corrected briefly following the Greenland rhetoric and moves in Japanese government bonds, but conditions have since improved and returned closer to the pace seen at the start of the year. In my view, this kind of volatility is likely to become more frequent over the course of 2026. The key for investors will be distinguishing between political noise and underlying economic performance. On that front, Europe appears increasingly well-positioned for continued positive momentum in the months ahead. Still, this is unlikely to be a smooth ride. Staying nimble and prepared will be essential. That's all for this week's edition of the Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It really does help others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit, our hub for macro, markets, and credit dynamics. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.